want to get back to what we're seeing this morning and the question really of this disconnect perhaps between public and private markets, or maybe the perceived disconnect. You guys priced your shares last night at $29 a share, which gave you a valuation of about $1.5 billion lower than the last private round, which SoftBank led. But the jump that we're seeing in shares today brings you above that latest round. So what were you hearing on the roadshow? Why the disconnect?
You know, I'm not today, and I hope I won't at any stage during our time as a public company be too focused on the price of shares. The short-term fluctuations, it's really noise, it's not a signal, and certainly the first 5 minutes of our trade are not telling anything about the longevity of our business and the value that we're creating. We do think there is an opportunity to create the 21st century incarnation of what a digital insurance company should be. That's a journey that will take us many years, if not decades. The nice thing about insurance companies is that they can endure for centuries and they can produce really massive returns. That is where we're focused. And therefore, we'll look at our price of our share every couple of years, but not every couple of minutes.
Daniel, that might be hard for some investors to do, but respect the long view. I want to ask about the operation of your model over time. It seems to me that, especially in insurance, having large data sets and having the best analytics running on top of that would be a key to success. How do you get both of those things?
You're absolutely right, and I think therein lies the structural challenge for incumbents who are founded during the era of the horse-drawn carriage, and that really is the fundamental advantage of companies founded in the 21st century for the 21st century. So being built on an entirely digital substrate produces data sets that are simply unavailable in a human-to-human interaction. We guesstimate that we are producing something like 100 times more data when we interact with our customers than our broker-based competitors. That is a profound advantage in any industry, but in an industry that is predicated on data, that is in the business of monetizing probability theory, we think that it is an enduring competitive advantage, and it just becomes more and more pronounced over time.
So how does that work? Are there data sets out there that are off limits, that you consider off limits to consider as you assess risk, or are you trying to pull in as much as possible about consumer habits, buying habits, social media, et cetera, to try to get the best sense of what your risk is?
You know, we're heavily regulated and we try to do absolutely the right thing at every time. So we're always deferential and respectful of not only privacy laws, but our customers' privacy expectations. So we're not trolling them or looking at their social media or anything like that. But when we interact with customers, there are signals that are being set off the whole time. And in a digital world, those are aggregated. Then the machine learning can correlate them or search for regression test them for correlates with claims. And that allows you to get ever better at offering the right product to your customer at the right price. And insurance, by law, is required to charge customers a rate that is commensurate with their expected loss. The more data you have, the more fair you can be, the more closely you can charge them something that is proportional to the risk they represent, rather than bundling together a group that is really not monolithic, treating them as if they're uniform, and just treating them all with one single price across the board. So I think the more data sets that we can use, we actually get closer and closer to the goal of judging people by the content of their character, not by superficial or just one or two other data points.